Although some of these drops have gaps, there are no major divergences with the AD indicator, especially with these three large red-bodied candles with small wicks that drop in the same direction as the gap downs and the larger downtrend. Drawing a trend line from the start of the next uptrend isn't very useful due to stretching for a longer duration and, to a lesser extent, being on a shallower angle. Focusing on a shorter time frame tends to have the AD indicator better identify larger breaks such as this one. And it's a similar situation here when the larger bearish reversal begins. Now here's an example where there's divergence. Right at the start of the new year, it appears AD is falling while price continues to rise. Rather than leading to a full bearish reversal, it demonstrates how the trend can weaken briefly prior to a continuation. And divergence between price and the AD indicator certainly helps define this area. When a downtrend does take place, we see a familiar instance where a large drop of the AD indicator takes place while there's little change in price. This is mainly due to high selling volume along with a proportionally higher upper wick compared to a small red candle body. Later, we can see the opposite taking place with a small green candle taking AD significantly higher due to its proportionally smaller body in comparison to its long lower wick and high volume. When the downtrend line of the AD indicator is broken, it helps confirm the approximate breakout area and the continued strength of this new uptrend. Drawing resistance and support areas, especially during a range-bound period, can be useful, but it's more of a secondary use similar to drawing a trend line on the AD indicator. In this case, there's divergence where price continues to move relatively range-bound while the AD indicator breaks significantly higher. This disconnect eventually leads to some bearish accelerations under the price range. Interestingly, shortly after, the opposite takes place and eventually results in the convergence of the two in the same general direction. Similar to how peaks and troughs don't always form uniformly between the AD indicator and price, the same could be said about the breaks of trend lines, which can take place at different times and places even though the trend lines are drawn from the same points. And that's why using AD in this way to identify breaks is a secondary use and not a primary analysis method. After all, the accumulation distribution indicator is meant for the identification and confirmation of a trend's strength, and to a lesser extent the possibility of a reversal when there's some divergence between the AD indicator and price. The main use of the AD indicator is not to identify areas where breakouts could occur. In the case of breakouts accelerating a trend further, it's more appropriate to use the AD indicator to confirm the strength of the breakout carrying the trend further. Marking trend lines and areas of interest on the AD indicator is optional. It's best to stick with the primary uses of this indicator.